Fear and greed. Where are we on the pendulum? I'm here with John Buckingham, and he's going to enlighten us.
Well, the fascinating thing about investor sentiment is that it seems like after you've had a big rally in the market, people get excited about stocks. They get more optimistic. After you've had a big decline, they get pessimistic. The stock market is one of the only places where they hold a sale and nobody comes. And you feel much more excited about buying things. Apple Computer, a perfect example. Mm-hmm. Maybe at 550, people aren't as excited about it anymore as they were at 625. And why is that? Well, because the trend has been, going in the wrong direction for a lot of investors.
Right. I wasn't excited with Apple at 13 a lot of years ago. But
well, we actually were. We were buying this. We actually bought the stock in the $7 range, and of course, we've sold pieces and pieces. I have sold 91% of my original Apple position. I still have a tiny piece left, but obviously, because it's appreciated so much, it's
right.
super.
And you live in a castle with a.
Well,
personal helicopter.
If I had 100% of my Apple, maybe so, but that's not good portfolio management to have all of your eggs in one basket. As we've seen with a 15, 17% pullback from the peak in Apple, anything can happen even to the greatest of companies. But these days, I think that investors are really scared about everything. And they're certainly scared about the equity markets. And the news out of Europe will drive things up and down. And if Merkel says this, we might have a rally. And if she says that, we might sell off. It's just an amazing thing, and if you look at it on a daily basis, it's going to drive you nuts. So we try to take that long-term view of things, and what we found from looking at market history is that often stocks will bottom when sentiment is miserable, and they may peak when sentiment is euphoric. And so where are we on that spectrum today? We're far more toward the fear end of things than we are toward the greed end of things, which is somewhat surprising given the rebound we've seen since October of 2011 lows. So these days we're really at a level where I think investors should be more enthusiastic about stocks based on history, how they often have gotten more excited when stocks rally.
Recalibrated valuations here.
Yeah, but it's fascinating that you have this big run up, and even the 100% plus rally off the March of 09 lows, and yet people are still taking money out of equity funds, U.S. equity mutual funds, and putting it into bond funds at where we are on the interest rate spectrum. It's it doesn't seem like the right trade to me, but it makes people feel good because there's less volatility in the fixed income space. But I really think that those investors who've shoveled money into bonds may be in for a rude awakening if and when, and I shouldn't say if, but when, those bond investments actually start to lose some value, because interest rates just don't go down. Interest rates can certainly rise, and I can assure you they will rise over the next 5-10 years, and they can rise probably pretty significantly. We can't have a zero Fed funds rate forever. And so at some point rates will rise, and those fixed income investments are likely to lose value, and I don't think people are ready who put their money in those supposedly safe investments to actually lose money. And so I think that you have too many people who've run to that side of the boat, and the equity side doesn't have much love. And I think that that's precisely a time where you want to be focusing on equities. And in the current environment, again, where dividends are very attractive, yields are higher than what you're getting on a 10-year treasury, I think that equities are a place for the long-term portion of your portfolio. Again, I'm not saying if you got money that you need to send junior to college in September, trade this summer. But for that portion of your portfolio that's designed for 3 to 5 years or even longer, I think equities deserve a place there.
Great. Well, thank you very much.
Thank you.
And thank you for watching the MoneyShow.com video network.